Alright everyone, Cowboy Trades here. Welcome back to the channel for another update on the markets. So this week is going to be absolutely massive for the markets. We've got a lot of important economic data coming out. The markets are going to be leaning towards the core CPI and headline CPI, but we also do have other things to talk about, such as initial jobless claims and consumer sentiment, all coming out in the next week. These things are definitely going to make major whiplashes and waves in the markets. We'll discuss all of this economic data, what to expect from it, and also new economic data that came out in the past few days or so. So first of all, I want to focus right now on what is happening in the labor market for the US. So if we start off with two pieces of economic data which are going to particularly affect inflation, these are both quarter-over-quarter reports. We had US non-farm productivity absolutely fall through the floorboards. This basically measures the annualized change in labor efficiency. Previous quarter, this was at 1.6% and it dropped to minus 2.7%. basically meaning labor is becoming less productive. Now, if we come over to the US unit of labor cost quarter over quarter, this took a massive run up, forecast to be 5.5%, but it was all the way up at 6.3%. So this is particularly bad for inflation. As I'm sure a lot of you know, if you've been listening to Jerome Powell's commentary, he's been talking about how it is currently the Fed obligation to see a softening in the labor market conditions, which means that workers will lose their jobs, they'll lose their hours, and they'll lose their raises. But what we're seeing right now is a hardening in labor conditions on these metrics, because obviously productivity is going down, but the markets are paying more for that same worker. So definitely not a good metric in terms of inflation. If this continues to persist, then inflation may remain sticky for much longer, but we'll talk about sticky inflation in just one moment. Now, if we come over to a few more pieces of economic data, you can see the US initial jobless claims rose to 242,000, previously at 229,000, but the unemployment rate actually dropped from 3.5% to 3.4%, and non-farm employment change actually went up. So right now we're seeing an increase in employment as well, and we're seeing the unemployment rate drop. So once again, this is a hardening in terms of labor conditions. If you understand, softening and hardening, the Fed has talked about this, specifically Powell, many times. To paraphrase him, he's talking about obviously when we raise the interest rates, these are going to cause softenings in the labor markets. Once again, that's workers losing their jobs, losing their hours, losing their raises. This would imply that the unemployment rate is going to go up and workers are going to get paid less. But right now we're seeing productivity go down, we're seeing labor cost go up, we're seeing that the unemployment rate is going down. These are all pieces of economic data which will harden the labor market. And once again, a hardening in the labor market will basically show that there's further strength in the US economy right now, and that will provide the Fed more opportunities to raise the interest rates further in the future. So Powell has said this many times. This is absolutely nothing new. The Fed will need to see a softening in the labor market before rate cuts can even be considered. So that's just a touch on some important economic data, specifically focusing on the job market that's came out in the past year. Once again, to summarize, labor market conditions are hardening right now, and if you want to see a rate cut, things like the unemployment rate are going to need to go up. Average hourly payrolls are going to need to go down. We're going to need to see these softenings take place before rate cuts can come and before the inflation rate can really stop becoming super sticky. But we'll talk about sticky inflation again in just one second. So if we come over to the economic data coming out this week. Now, the most important pieces of economic data next week will be coming out on Wednesday. That is, of course, going to be the US CPI year over year and the US core CPI year over year. Now, in terms of headline inflation, this is actually predicted to remain at 5%, further implying that inflation is going to remain sticky. For the US core CPI, this is expected to drop to 5.5%, really not a big drop from 5.6%. So right now we're really seeing inflation, especially US core inflation, remain extremely sticky around this 5.5 to 5.6% region. If we come over to the sticky metrics of both the headline CPI and core CPI and look at the sticky CPI and core sticky CPI, you can basically see since the month of September 2022, sticky inflation has absolutely not moved. In September 2022, sticky CPI was at 6.5, core sticky CPI was at 6.4. Right now, these are at 6.6 and 6.5% respectively. So if we see some stagnation in headline inflation, or we see a 0.1% drop in terms of core inflation, we might find ourselves at the exact same level as we were in September of 2022, meaning, inflation is remaining extremely sticky right now. And of course, the Fed are probably going to have to do other things other than raise the interest rates. They'll probably have to keep the interest rates between 5 to 6% for the next year or so. They have been discussing how they are not going to be looking to cut the interest rates in the following year. Once again, the most recent commentary we got from Powell was if inflation stays high, we won't cut rates, and the FOMC's inflation outlook doesn't support rate cuts in 2023. He's been saying this for a very, very long time, so in my opinion, we're going to see sticky inflation persist. We might see a slight drop in core in the next week, but sticky CPI is still going to be persisting in these markets. Now, for the rest of the week, we don't have anything major. However, on Thursday, we do have another report for the US initial jobless claims. Jobless claims are expected to remain at pretty much the same level. They're forecast to move up to 245K from 242K. So I don't think this is going to be a major move. However, we do have the US Michigan consumer sentiment, which is also pretty much forecast to remain the same as the previous month. This previously came in at 63.5% and it's forecast to drop to 63%, basically meaning that consumer sentiment is becoming slightly weaker right now. The markets are kind of very slowly becoming less and less confident. But once again, like I said, these two metrics that we just looked at, they're really not predicted to move much whatsoever. So what I really want to highlight is coming into the following week. Wednesday's CPI is going to be important, but in my opinion right now, core CPI is far more important than headline CPI. Why is this? Well, headline CPI is right now at 5% and core CPI is at 5.6%. Even if this drops down to 5.5%, we're going to see core CPI continuing to absolutely eclipse the CPI index. Normally when you see core CPI linger so much higher than headline inflation for prolonged periods of time, this is almost always an indicator that you're seeing sticky inflation in the markets, and that is exactly what we've been witnessing since September of 2022. If you come over to things like the flexible CPI, you can see how these flexible categories of consumer price inflation have been moving, very quickly to the downside. We're actually seeing core flexible CPI start to push up once again. This did move into the negative territory, but it is starting to move up once again. So I'll keep you up to date on this. I personally think we might see some core flexible CPI components start to move up once again. And if that happens, we might not even see core CPI or core sticky CPI budge whatsoever. Inflation is going to remain extremely sticky, and the labor market conditions are still remaining extremely hard. We do need to see a softening in labor market conditions. We do need to see a drop in some of these very important components of CPI like core CPI before rate cuts will be considered. So coming into next week, that's really all the important economic data. In terms of the S&P 500 technical analysis, where you really want to keep your eyes on is this level right here at 4,193. This is the previous wave C of this asymmetrical triangle. So if the S&P 500 remains beneath this level, we may see a drop all the way down to the bottom of this asymmetrical triangle at 3,955. If inflation really does have a big drop and we do start breaking above this level, things could definitely lean short-term bullish. But like I said, a lot of this is data dependent. We'll need to see what happens on Wednesday. S&P 500 insider traders have also quite recently sold this most recent rally, so that might be something you want to take into consideration coming into the CPI report. And also for Bitcoin, really, we're just range bound right now. We are in a major area of previous support flipped as resistance until we have a major move outside of this big red rectangular box. Then there's not too much to update to the upside. If you're bullish, you'd want to see a break of 32.5. If you're bearish, you'd want to see, weekly candle body closes and rejections beneath 28,000. But like I said, a lot of this is data dependent. Let's see what happens on Wednesday with the inflation numbers. So for today, my friends, that's all I've got. If you do enjoy my content, as always, let me know down below by leaving a like and a comment. Share the videos with your friends. If you want to further support the channel, feel free to click the join button and become a member today. Follow me over on Twitter at 618_cowboy for these posts prior to my YouTube videos. Stay privy of the markets when we have this economic data coming out. As you can see, most of this data came out on the 4th or the 3rd of May, and I shared it once it came out. So sometimes when I'm away from YouTube, it takes a little bit of time to record these videos and get up to date. But if you're following me over on Twitter, you'll get all of this information as soon as it comes out. So at 618_cowboy, hope to see you on Twitter. As always, it's been your boy Cowboy Trades. I'm out, my friends. Peace.